So when we look at double declining, you can see its graphs look much different, right? The cost is depreciating so much in the first couple of years. So your depreciation expense the first year is very high, and then it kind of levels off over time. So same with your book value. Your book value sees a sharp decline in those first couple of years because we're depreciating pretty much double in the beginning. Okay. So again, advantages of this are to expense it out faster. It can help us then if we need to have other expenses or we need to purchase a new asset in those last couple of years. And this is just a nice slide. You can print this off from the PowerPoint because it just reviews the three methods and kind of gives you the depreciation rate and the depreciable cost and all that. So it's just a nice summary. And there's just another summary showing you the different methods. Again, the takeaway is it doesn't matter which method we used. We depreciated $22,000 over 5 years. We just did it different ways. Okay. But under all three methods, your total depreciation was the $22,000 depreciable cost. So when does depreciation get a little tricky? Well, like I said, very rarely do we bought this forklift on January 1 and we use it for 5 exact years, right? And dispose of it year 5, December 31st. So we don't want to depreciate something when we haven't had it the full year. We only want to depreciate it for how long we've had it. So when things get a little tricky is if we buy something and it's not the first day of the operating year, then we need to do partial depreciation for that first year. Now, year 2, year 3, year 4, maybe we had it the whole year, so we can use the whole year's depreciation. But that first year, if I bought it like April 1, then I've only had it for 9 months. I just want to calculate 9 months worth of depreciation. Okay. Or in the case they give us, we place an asset in service on March 1st. So we've had it for 10 months. We didn't have it January or February, but we had it the remaining 10 months. So we want to calculate or prorate depreciation for those 10 months. Okay.
We just prorate for days?
Thankfully, no. We'll just prorate by the month. So kind of the general rule is if it's the first half of the month, so like the 1st through the 15th, we would count that full month as ownership. If we purchased it, say the 16th through the 30th, we would calculate it based on the next month's ownership. So yeah, that's a good thing. It's not like a note where you have to calculate days. So it'll just be months. We'll always prorate on a monthly basis. And most of the time they'll have it like March 1 or, they try to make it a little smoother. So I think that's what I just said. So yeah, if it's an asset placed in service in the first half of the month, we'll assume that we'll just count it the whole month as having owned that asset. If we purchase it in the later half of the month, we'll go to the next month. Straight line method, it's really not very difficult. We can quickly take a yearly depreciation rate, divide it by 12 to get a monthly amount. Okay, so it's really just kind of separating it out. So same example, but we're going to look at, well, what if we purchased that forklift on October 1st instead of January 1st? Well, then we owned it October, November, December, right? So we've had it for 3 months. And yeah, it's one of those days I had to count. No, I'm just kidding. So we owned it for 3 months out of the year. So in that first year, we don't want to depreciate it the full annual $4,400. We just want to depreciate for 3 months. So they took it 4,400 times 3 divided by 12. Okay, we owned it for 3 months. You could take 4,400 and divide it by 12, right, to get a monthly amount, and then multiply it by 3. However the math makes sense in your head. I know everyone sees math a little differently. So, or you can take 3 divided by 12 first, however you want to do it. But basically the end result is we had it basically 1/4 of the year, right? A quarter of the year. So it's 1,100 worth of depreciation that first year. Does that make sense? Mm-hmm. Okay. So it's not too bad. It's It's just one of those things on tests you have to pay attention to, right? Like, you know, read the question because maybe we didn't purchase it on January 1st. So it's more just a detail thing. And honestly, I don't even think we do any dealing with units of activity in partial year. I think the only one we deal with partial year is straight line, just to keep it simple. So we're going to skip that one. Same with double declining. And the last part of really dealing with depreciation is if we have to revise it. So, you know, again, in a perfect world, we would have that forklift for 5 years. We would depreciate it for 5 years. We would dispose of it or sell it. We would get our $2,000 and move on with life. But that's usually not the case, right? Like, what happens if, you know, Bob is driving the forklift and he wrecks it and totals it? It can happen, right? Bob's a really bad driver. Then, you know, we're going to probably have to get rid of that forklift if he totals it before the 5 years. Huh? And probably Bob too, exactly. Unless he has a very good, like he had, you know, a stroke or something. But yeah, Bob and the forklift are probably going to be gone, so we'll save some money there, at least in temporary. Or again, you know, it could just be that the forklift only lasts 4 years instead of 5. Or maybe the forklift, we determine at year 5, it's still really going strong, and we use it for another year. So there's lots of reasons we might have to revise depreciation. So residual values can change, useful life can change, and that can be based on normal wear and tear or just becoming obsolete. And then we just have to recalculate depreciation. Once we've determined that one of those things has changed, we would want to recalculate, okay? So this is the new machine that we purchased on January 1 that cost us $140,000. We expect to use it for 5 years, and we expect the residual value to be $10,000. So they did straight line depreciation, it would be $26,000 per year. So we've actually had it for 2 years. So we're at the end of the 2nd year, and we've depreciated it $26,000 year 1 and year 2, so a total of $52,000. So its current book value, the cost minus accumulated depreciation, is $88,000. At the beginning of that 3rd year, we realized that we can actually use it for 8 years instead of 3. It's a big jump, isn't it? Seems a little extreme, but we'll go with it. And then its residual value would drop from $10,000 to $8,000, which doesn't seem high enough for 5 more years, but we'll roll with the example. So we would want to recalculate it. When we recalculate, we always go off of the current book value. You see that here. So our revised depreciation, we don't go back and mess with what we've already depreciated. We're just going to leave that as it is on our books for the last 2 years. We're going to take our book value, so our current book value, minus the new residual value, so $88,000 minus $8,000, and divide it by our new useful life. So from year 3 on into year 8, or however long we have it, we're now going to depreciate at $10,000. So at the end of year 3, our depreciation expense will change to $10,000.
How's that with the straight line depreciation?
That is the straight line depreciation. So we just revised it. So before, because I think we only had it, what was our old? We had only initially anticipated using it for 5 years. So the first 2 years, we depreciated at $26,000 based on that. But then year 3 through 8, we'll depreciate it, or actually through 11, because I think 8 more years. We're going to depreciate at $10,000.
Okay.
Yeah. So we don't have to go back and mess with what we've already done. We just revise it. We always go book value minus the new residual divided by the new life. So it's really the same formula. You just have to know what the book value is. Okay. And then from year 3 on, we would have $10,000 of expense. And there it kind of shows you what that, you know, we were on more of a rapid depreciation. We were going to get rid of it in 5 years. In year 3, that changed, and we're going to keep it an additional 8 years, which seems like a big adjustment, but I'm sure they're just doing that to make it easier to illustrate. It's probably not very common to go from 5 years to like 11, but we'll roll with it, right? Do it.
It's almost missed all the boats.
Right? The other things that can change the cost of your asset is we have to consider, and we have to consider as far as depreciation goes. Again, land's not really going, it's never going to change. But say, you know, my forklift, again, we'll go back to the forklift. Say the engine goes out in like year 4. And we're like, well, it's actually cheaper to replace the engine than to buy a new forklift. We'll just assume. I know nothing about those prices, but we'll make an assumption there. At that case, that's a big expenditure, right? I'm like replacing an engine, which is going to increase the life of that forklift, and I'll be able to use it longer. So when we make an expense, or when we incur a cost on an asset that kind of makes that asset last longer, that's considered what we call a capital expenditure. So, you know, this building, for instance, this is a true story as well. This building is one of the first original buildings ever at State College, which if you don't know, we're coming up on what, our 50th, our centennial anniversary next year. So this building has stood here for 49 years. Well, as you can probably imagine, we do not have the original flooring and walls and doors and all that we did 49 years ago. So when they first bought this building, I'm sure they did not expect the useful life to still be standing here. So over the years, as they've upgraded, and I think it was like 3 or 4 years ago, since I've been here, you know, they put in new flooring and painted and did some, like, put in the sprinklers and all of that. Those are all capital expenditures because it's making this building last longer and longer. So, you know, it's been through several remodels and repairs and things like that. So those big remodels that are making this building, well, bringing it up to code, which is always good, right? And making it last longer, those are all capital expenditures. However, you know, replacing a door that broke is probably just an expense. You know, the door was old, we had to replace it. It's not really extending the life, it's just a door. You know, there's different types of expenses that go in with assets. So anything that extends its useful life or its value is going to be considered a capital expenditure. That's going to be added to the cost of the asset. So if I replace this engine and it was $5,000, I'm going to add that to the cost of the asset, and I'm going to have to factor that into my depreciation. It's probably going to change though, right? I'm going to have to extend the life of it as well, okay? If I got an oil change on my forklift or replaced a tire, or I don't know, I'm assuming they still have spark plugs, I don't know. I know nothing about forklifts, obviously, so just like Bob who was driving it. So those are all just revenue expenditures. So those would be expensed out. Oil change, any maintenance costs, we would just expense out. Okay. So those are going to impact how we deal with that asset moving forward. Okay. We're pretty much at the end. So as you can see, if it's just a revenue expenditure, we would just put it in some expense account. If it's a capital expenditure, again, it would be added to the asset itself. And we'll talk more about that, but there it is kind of showing you. Yeah. That's adding a hydraulic lift to a delivery truck, so it's increasing the asset itself. And then we would have to revise depreciation. Okay. Again, it's another long chapter, and we'll kind of talk about, on Thursday, we'll kind of cover getting rid of fixed assets. That's our last little section. You know, what happens when we are actually done with it? Did we sell it? Did we make money? Did we lose money? You know, all of that. So we'll wrap that up, and then we'll do examples together. Again, check your Cengage and let me know if you have no access. If you find you do over the next day or two, send me an email and we'll be getting that fixed. And have a great